Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by J.R. Johnson LLC, specialists in multifamily restoration and repair work. Gantry Incorporated, the nation's largest independent mortgage banking firm.
Welcome to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. And today we're going to be doing some Zoom interviews, and we're lucky to have John Gillem, Director of Market Analytics with CoStar Group here in Portland. CoStar Group's national, but John covers the Portland market. So John, thanks for taking the time to talk to our audience a little bit about kind of what you see. For people that don't know, or we're very familiar with CoStar and what they have, but for people maybe that aren't in a daily business in the commercial real estate world, maybe give a little background of the breadth of research that you guys are involved with, and we'll start getting into some specifics about Portland and the rental market and what you're seeing.
Thanks so much, Greg, for the opportunity. And here at CoStar, we're a leading commercial marketplace and analytics firm. So we're going to have deep insights into all four of the main property types. So office, industrial, retail, and multifamily. And in addition to that, we're gonna be the leading, in addition to our analytics platform, we're kind of the leading marketing platform for advertising, buying, selling, listing for rent. We also have apartments.com under our umbrella, which is the leading rental platform. We have billions of data points of rental figures flowing through those feeds and used by all the major developers and property managers. So a growing company with a pretty good scale globally too. We're expanding into Europe right now.
Oh, you are now? Okay, interesting.
Right. In addition to our presence in North America and the UK, we're moving into other parts of Europe as well.
Because I know when we first started dealing with CoStar years ago, it was more on just a sales transaction, and then like you said, you guys now own apartments.com, so you're able to get, in our world of multifamily, able to get kind of rents as people are advertising available rents, so you can get that data as well, which has been very helpful in doing our research and looking. So I'm glad that's all put together. Maybe we can jump right into kind of some of the recent, again, for multifamily, kind of the recent rent trends that you've seen, the occupancy, and let's talk about rents and that, and then we'll get into sales. I mean, what have you seen the last 2 quarters in terms of rent growth within the Portland PMSA? Then we'll talk about some tertiary markets as well.
Sure. So speaking from a high level, rent growth on an annual basis has corrected and eroded drastically from its various high points reached in 2021 and early 2022 for some regions and some submarkets. Kind of that peak, those peak growth figures kind of spread out for different areas. And were achieved, earlier or later. But part of this is a result of base effects. Statistically, it's hard to continue to generate, double-digit gains year over year as that base comparison mark continues to rise. Eventually, given other macro factors, trends are going to regress back to the mean. Simply because linear growth into perpetuity is pretty difficult to achieve. There's going to be ups and downs along the way. So currently Portland's average or, market rental rate, as we call it, amounts to just over $1,600 per unit. And that's all units kind of across the board.
So that's all unit type, that's A and B properties. That's all kind of units. Okay.
Right.
Okay.
Everything. Correct. And different bedroom types as well. It's kind of that asking or average rate that a renter could expect to pay, kind of across that spectrum. And that's just behind the national index of about 1650 a unit. So those figures indicate current rent growth on an annual basis of just under 3%, going back 4 quarters, which is well below the peak in late 2021 of over 9%, but actually in line with our data's long run average of around 2.6%, going back to about 2000. So So
when you go back to 2000 and look at annual rent growth, you're looking at just under 3% on an annual. We'll get markets years that go up and down, but if you annualize that over.
Correct. Absolutely correct, Greg. Okay. Absolutely. And occupancies right now hovering right around 94%. And as I'm sure you know, down slightly in recent quarters, but in line with our 10-year average there. And the core, I think notably some of the core submarkets have seen occupancies rise as people have kind of generally been making their way back. Not necessarily for work, right? Because the downtown office market is still in is still in a flux, but people kind of wanting to return to get back to some of that synergy, back to some of those services that some people feel they can't get in the suburbs. I don't think the suburbs had staying power for everybody that moved out there. I think a certain number of people will certainly stay out there, and that growth out there will be relatively sticky. But for some, I think the urban core is a little more appealing. So we've seen core occupancies rise. And for a variety of reasons, we'll get into later here, sales activities down across the board, across the nation.
And then I'm curious on the rent side is something we've always had sometimes trying to get information. How do you factor in concessions when you're looking at average rent? Are you taking, if it's a 2 weeks off or something like that, or 4 weeks off on a 12-month lease? How do you factor that into that number? Or is it kind of case by case?
You're right, case by case. So we're gonna have our market rent series, and then we are gonna have an effective rent series as well. And what you'll find, Greg, is at the metro level, those series are usually going to be pretty tight. They're gonna mirror each other pretty closely, and that's because the sample size is going to reflect the entire metro areas inventory. And so some of those, we're not able to capture some of those concessions in, say, units that have never, mom and pop units that have never had a vacancy or have never listed any concessions. If you narrow that search parameter to the newest buildings, especially high rises in the core markets, you're going to see a bigger spread between the market and effective rate. And our researchers, a lot of those effective numbers are captured by research. They're calling on the biggest properties to the biggest property managers, and a lot of it's coming in off of the proprietary feed of some of the bigger PMCs as they enter it, and it's on apartments.com, and we scrape that out and pick it up.
So the trend you're seeing is yes, we're not having close to double-digit rent growth, but we're back more maybe to a normalized trend is what we've seen historically for the last almost 20 years of just under 3 if you annualize that out. So it's we're still going. It's just not to the same clip as we've seen for the last year, 18 months.
Right. That's correct. Some of it, some of that's supply driven, and we've got a pretty, the pipeline, as I'm sure has kicked back up a little bit lately. So that's contributing. Leasing slowing down just a little bit. Renters are battling inflation. I think some are hesitant to sign leases. That could continue near to midterm. So yeah, and it kind of my colleague in Seattle, Elliot Kravenko, brilliant guy. He kind of refers to it as not falling skies, but kind of shifting grounds. Kind of the market normalizing and figuring out where its footing is going to be.
And are they seeing the same kind of trends in Seattle as well? I mean, is Portland's not unique in terms of what we look, as opposed to probably, I'm assuming a lot of the cities on the West Coast. Our rent numbers might be lower, but what we're seeing on the rent growth and the annual growth is probably close to the same.
You're absolutely right. Similar trajectory in Seattle. They're dealing with a massive supply wave. They've got some issues that they're going to have to work out downtown with Amazon kind of saying, oh, maybe we're going to go to Bellevue, and maybe we don't want to have as many people downtown anymore. So yeah, it's a similar story. And then some of these other, just a couple tertiary examples. Coeur d'Alene over the past couple of years has been one of the biggest relocation metros in the nation. Massive influx of people. They saw, well, all of a sudden, developers really got to work there, and it's easier to get projects permitted and out of the ground there. So now they're dealing with a historical supply wave in the face of slowing leasing. So their vacancy rate has skyrocketed, and we expect rent growth there to go negative over the coming quarters.
And would you say the same thing for Boise too? Probably.
Same thing for Boise. Boise rent growth could go negative, and the one thing to remember about Boise, it's obviously a bigger market, and more capital is poured in there over the years, but Boise's potential saving grace could be the Micron fab plant. So obviously they're dealing with, same thing, a huge glut of supply and steady but slowing leasing, and steady but slowing population gains. However, I think I've talked to sources close to that project, and while I can't give an exact figure, that project's going to bring a ton of jobs to the region. A lot of those are probably going to have to come from out of state because the unemployment rate is so tight in Idaho, and a lot of those people are going to need permanent housing, from the the skilled trades to the more white collar jobs, architects, engineers, et cetera. There's going to be to a certain degree a need for housing there, just associated with that project.
Got it. Interesting. Well, so let's talk a little bit about sales of the multifamily. You mean 21 was a record year, I think, nationally and regionally and locally on the volume and number of transactions and dollar volume. And last year I didn't expect 22 to be like 21. I thought we wouldn't maintain that same momentum. And actually, if you annualized 22 from October on. If you take the fourth quarter out, it wasn't going to be 21, but it was still very, very good. Fourth quarter definitely dropped down. Okay, what did you guys see in your research in terms of sale volume and pricing and things like that?
Very, very similar, Greg. Very similar. So I think if you our sales volume and disclaimer, we're including, in the volume I'm about to share, we're including deals that traded without. Where we weren't able to confirm a list price. We're estimating some of those prices.
I got you. Okay, so if you can't confirm the list price, you'll estimate kind of where you think it is
on the back end data that I'm using. So in the product, those are going to reflect. But so we tracked about $4.5 billion dollars of volume in 2021, to your point, and we slowed, like you said, as was expected, slowed particularly in the second half of 2022 to a total for the year of right around $3 billion, which was still the third highest year we've ever tracked all time. I believe in 2016 we had volume of it was 2016 or 2017 volume of just over $3 billion.
Yeah, we just got barely over 3 million, and then like I said, 21 we had the huge over 4, and then okay.
Right. So a slowing down, and like you said, particularly in the second half. So right now, the Fed's tight monetary policy is doing just that, right? Restricting the money supply. Cost of permanent financing, loans, mortgages, has doubled since mid 2020. And if I could, I'll share really quickly a chart about, because the big question everyone asks is, how long is the Fed going to be hawkish for? And we can unpack a little bit of that in our CPI growth, which, as you had alluded to earlier, Greg, is still quite high, right? At around 6%. While it appears that peak inflation is over, we've still got a ways to go. And I think the Fed. The other thing is a couple of things to consider here. Fuel, energy, and food are pretty volatile, so expect those to remain volatile in the coming quarters. They make up a big portion of this reading, and it's going to be interesting to see what this does in the coming months. But getting back to that 2% target is going to take some work. So I think the Fed, the current banking, the jitters around the banking liquidity right now could cause the Fed to maybe reconsider their terminal rate. I know some investors are pricing in actually a rate hike pause, but most actually just reduced their expectations from about half a point to a quarter of a point. So I think the Fed remains fairly, I would guess, and I would expect the Fed remains fairly hawkish going forward, with maybe a little more caution on their part, but a lot of work still to be done there, and that keeps the cost of money high, and it keeps investors' debt obligations high. All of a sudden, I need to cover risk-free rate and treasury spreads, And, with higher return needs, I can't offer the same price. So we're seeing, some buyer seller disconnect. I'm sure you guys are seeing that, and
Yeah.
it's causing activity to slow a little bit. We don't know exactly how much dry powder is out there. There's certainly some, and for the bigger institutions, it's their capital stacks are a little bit easier to put together, and they can make deals that make sense will trade. But I think in general, the expectation is that sales could continue to slow. And I think you had agreed with this, Greg, through at least the first half of 2023.
Yeah, we kind of figure the first 2 quarters. Yeah, the first 2 quarters you'd see a slowdown, and even like you said on the larger assets, it's almost that who's going to go first. It's almost like a resetting of expectations, and when you're having these big swings and shifts, the disconnects greater than it has been before. So as it gets tighter, but then who's going to be the first one to kind of jump back in? And we kind of felt a little of that in coming out of 2009. Typically, coming into 2010, it was the institutional capital that really turned our market around, and the private capital kind of followed. We may see that, private capital sells for some different reasons, but it's, I think the next quarter will be probably slow, and we'll see what the Fed does. But as people kind of readjust and kind of say, okay, here's the landscape, maybe there's a little bit more certainty. Yes, the rates are higher than they were, but at least, we're not thinking it's, bouncing all over the place, and maybe we'll see some volume kind of kick up.
Absolutely, Greg. I think you hit the nail on the head. A stabilization in the expectation of where rates are going to go, I think would go a long way, for a lot of different reasons. But yeah, absolutely.
So then I know you and I have talked before about kind of what we saw, which was interesting the last couple of years, about the sales volume from primary, cores within the metropolitan area to tertiary markets. You think that's going to continue as we come into 23 and then 24, that we'll see that distribution of sales, again, kind of a lot more in the tertiary markets? Or do you think it's going to follow like you talked about, as populations maybe come back to the core? You think the sales volume will, I don't want to say normal, but get more of a distribution that like we typically see, where predominantly it's within the city, in the tertiary markets are kind of lagging behind?
Yeah. So I think, I did a little bit of a, and as everyone knows, that this rush in the past 18 months to secure assets in Portland, that I did a little bit of an analysis. Obviously, that rush that has since slowed down, but I did a little bit of analysis. Right. I tracked sales of over 25 million, and I found that the distribution across the metro area, Greg, was pretty uniform. We used to have most of those huge deals getting done. They were probably a little more concentrated in those core submarkets, but that's really started to expand, which kind of alluded to at that time investors' willingness to really scoop up assets wherever they could get a hold of them, because the Portland market was so tight. And I think some of that dynamic will change a little bit as supply is catching up, and investors and landlords are going to have to compete a little more for renters. But I don't know if you agree, but I'm seeing value add deals in the suburbs right now. I think for some investors, they believe those are going to be the pretty stable going forward as far as Portland goes. You pick up a community out there, do a little bit of a facelift, boost the rents a little bit, and depending on your time horizon, given areas in the suburbs that are close to some of those large job nodes, your returns could be quite attractive. I think if you're a a large and experienced operator that knows how to go in and make those changes quickly and dial the rents right where you want them. And then obviously, the big deals that make sense in the cores will still get done as well. I had one example that we saw recently, Reveal in the Pearl District on Quimby Street, with LiveCore picking that up. Alliance was the one that developed and offloaded that. But and I don't want to speculate on the reason I bring it up, Greg, is the pricing to me seemed a little bit low, on a per unit basis, given what communities in the core usually sell for. And I don't want to speculate on why, Alliance offloaded that. It could have been maybe they were having trouble, securing bridge financing or whatever. I don't want to speculate, but occupancy was well above 80%. And LivCore, I think they, obviously LivCore does their homework. So I think for them, this purchase made a ton of sense, because you're looking at, an asset in the core, in one of the nicer parts of the core, that maybe they feel, occupancies will continue to rise going forward and stabilize. And, as the core starts to fully recover, from some of the issues we've had over the year, which will take time, I think they probably believe that long term, they got pretty good value on this, and that they can get this to stabilization. And again, depends on time horizon, right? But I think that it made sense. It made sense for them.
Well, I think that kind of goes as kind of the thing we were talking about is deliveries. Is yes, deliveries kicked up a little bit, but if you look historically, we still are going to be severely under-delivered. So I think I think a lot of it have to do on the buying side is, I think they've had to extend out their time horizon. But if they're looking at some of these assets and saying, if my basis is here, what's, my below replacement cost? We know the difficulty of getting projects done within, Portland in particular, and kind of the barriers on that, just from costing, just dealing with the city. So I think there's a thought of, hey, if I can get in there, it's not something I'm going to flip out of in a year or two, but I've got a good basis in it. I believe in it, where we're going to go, and I'm not overly concerned about massive amounts of oversupply, which we see in some, the Phoenixes and the Dallases of the world, where you have these oversupply markets and occupancies go down and vacancies are going up. That's typically not the trend that we see in this market. And I think that's why we'll see capital coming up here. And I think that's why, I think we both kind of feel that next quarter, into the second, third quarter, we'll maybe see some, sales kind of generating again.
Yeah, barring any, unforeseen cataclysmic,
right,
economic events or crashes. Yeah, I would generally agree. And yeah, I say, and you make a great point, Greg, I say, supply is going to be increasing. Developers are getting back to work. Permitting gives us a good leading indicator, but some developers hold on to permits. Those don't always get to market right away. And a lot of these projects going up now were permitted pre-pandemic and then put on hold, and now they're moving again. But on a magnitude, on the basis of magnitude, our pipeline, while it has rebounded, and we are going to have a ton of units, actually, particularly in Vancouver, of note going forward, the magnitude does not compare, like you said, to a Phoenix, or what Phoenix is experiencing, or even places like Dallas and other places in the Southeast, where the permitting process is just a lot more streamlined, and they can get units out of the ground much quicker. And they're going to be dealing with a big slog of supply over the next few quarters, for sure.
Yeah. So that, in terms of coming out of this, coming out of COVID, and has there been any things that are kind of surprises to you, and being in the research side, that you touched on a little bit, maybe the pricing of the project in the core, but is there anything else I think I was a little surprised about the amount of capital willing to go in some of the tertiary markets. Really like sub-tertiary markets, really small markets that 3 years ago or 4 years ago, we would have said something that from a city of a population of 25,000 or under, there wouldn't be that much interest. I was surprised at how much capital would go there. That's kind of pulling back. Is there anything that's kind of surprised you over the last, year or 6 months as you're looking at the data?
Yeah. So I think that, and across the board, while we expect sales to slow over the coming quarters, that is going to be, some of these tertiary markets like Salem, Eugene, and Bend. We do expect the same thing. Bend is getting a lot more attention. I think mostly because it's one of the fastest growing small to mid metropolitan areas in the country. So I think it will continue to get a lot of attention. As far as surprising really was that rise in pricing leading. I guess it was surprising to me because, like you said, some of these tertiary markets like McMinnville getting 8 8-figure deals done, stuff there, selling for 10 million plus. That was never the case beforehand. But even areas on the east side, like Gresham, which and it kind of goes back to what I talked about, that distribution of $25 million sales, we're seeing, on a per unit basis, deals closed for well over 300,000 a unit, and that was just unheard of 5 years ago. But I think it kind of speaks to, and at the time spoke to, but speaks to, Portland does have a bit of a pricing advantage versus some of these other gateway markets relative to, if you factor in wage growth here. It's the pricing here, if I'm an investor looking at Portland or the Bay Area or Seattle, while I can't give investment advice, but you can look at it and see that on a per unit basis, it is more affordable than some of those other gateway markets. So we saw on a per unit basis, I think investors were really at past 18 months willing to pay whatever they needed to secure those assets kind of across the region. And we've seen expect a normalization of that, in the midterm, but market pricing per unit really kind of exploded over the last couple of years leading up to the current slowdown here.
Well, great. Well, thanks for taking the time. I'm sure the audience was, good to always hear your perspective. You've got a real good pulse on the market in terms of the data and the research. So we'll have you back again. It'll be, I'll schedule you, I think maybe the end of second quarter, and we can see if our kind of predictions are coming to. We'll see some of the volume increase. But again, thanks for taking the time to do this, and we'll see you again on HFO-TV. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.